moved up over the past year, mainly because of the diminishing effects of the earlier declines in energy prices and import prices. Total consumer prices, as measured by the Personal Consumption Expenditure, or PCE price index, rose 1.6% in the 12 months ending in December, still below the FOMC's 2% objective, but up 1 percentage point from its pace in 2015. Core PCE inflation, which excludes the volatile energy and food prices, moved up to about 1.75%. My colleagues on the FOMC and I expect the economy to continue to expand at a moderate pace, with the job market strengthening somewhat further and inflation gradually rising to 2%. This judgment reflects our view that U.S. monetary policy remains accommodative and that the pace of global economic activity should pick up over time, supported by accommodative monetary policies abroad. Of course, our inflation outlook also depends importantly on our assessment that longer-run inflation expectations will remain reasonably well anchored. It is reassuring that while market-based measures of inflation compensation remain low, they have risen from the very low levels they reached during the latter part of 2015 and first half of 2016. Meanwhile, most survey measures of longer-term inflation expectations have changed little on balance in recent months. As always, considerable uncertainty attends the economic outlook. Among the sources of uncertainty are possible changes in U.S. fiscal and other policies, the future path of productivity growth, and developments abroad. Turning to monetary policy, the FOMC is committed to promoting maximum employment and price stability as mandated by Congress. Against the backdrop of headwinds weighing on the economy over the past year, including financial market stresses that emanated from developments abroad, the committee maintained an unchanged target for the federal funds rate for most of the year in order to support improvement in the labor market and an increase in inflation toward 2%. At its December meeting, the committee raised the target range for the federal funds rate by 1/4 percentage point to 1/2 to 3/4%. In doing so, the committee recognized the considerable progress the economy had made toward the FOMC's dual objectives. The committee judged that even after this increase in the federal funds rate target, monetary policy remains accommodative, thereby supporting some further strengthening in labor market conditions and a return to 2% inflation. At its meeting that concluded early this month, the committee left the target range for the federal funds rate unchanged, but reiterated that it expects the evolution of the economy to warrant further gradual increases in the federal funds rate to achieve and maintain its employment and inflation objectives. As I noted on previous occasions, waiting too long to remove accommodation would be unwise, potentially requiring the FOMC to eventually raise rates rapidly, which could risk disrupting financial markets and pushing the economy into recession. Incoming data suggests that labor market conditions continue to strengthen, and inflation is moving up to 2%, consistent with the committee's expectations. At our upcoming meetings, the committee will evaluate whether employment and inflation are continuing to evolve in line with these expectations, in which case a further adjustment of the federal funds rate would likely be appropriate. The committee's view that gradual increases in the federal funds rate will likely be appropriate reflects the expectation that the neutral federal funds rate, that is, the interest rate that is neither expansionary nor contractionary and that keeps the economy operating on an even keel, will rise somewhat over time. Current estimates of the neutral rate are well below pre-crisis levels, a phenomenon that may reflect slow productivity growth, subdued economic growth abroad, strong demand for safe longer-term assets, and other factors. The committee anticipates that the depressing effect of these factors will diminish somewhat over time, raising the neutral funds rate, albeit to levels that are still low by historical standards. That said, the economic outlook is uncertain, and monetary policy is not on a preset course. FOMC participants will adjust their assessments of the appropriate path for the federal funds rate in response to changes to the economic outlook and associated risks as informed by incoming data. Also, changes in fiscal policy or other economic policies could potentially affect the economic outlook. Of course, it is too early to know what policy changes will be put in place or how their economic effects will unfold. While it is not my intention to opine on specific tax or spending proposals, I would point to the importance of improving the pace of longer-run economic growth and raising American living standards with policies aimed at improving productivity. I would also hope that fiscal policy changes will be consistent with putting U.S. fiscal accounts on a sustainable trajectory. In any event, it is important to remember that fiscal policy is only one of the many factors that can influence the economic outlook and the appropriate course of monetary policy. Overall, the FOMC's monetary policy decisions will be directed to the attainment of its congressionally mandated objectives of maximum employment and price stability. Finally, the committee has continued its policy of reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. This policy, by keeping the committee's holdings of longer-term securities at sizable levels, has helped maintain accommodative financial conditions. Thank you. I would be pleased to take your questions.
Thank you very much, Chair Yellen. And I want to get into that last issue you talked about with regard to the Fed's balance sheet. But before that, I've got 2 or 3 quick questions I just wanted to go through with you. First, Dodd-Frank established a new position at the Federal Reserve, the Vice Chairman of Supervision. President Obama has never yet designated anyone for this role, and instead, Fed Governor Dan Tarullo has acted as the de facto Vice Chairman for Supervision in various ways, including by chairing the Federal Reserve Board's Committee on Supervision and Regulation, overseeing the large institution Supervision Coordinating Committee, and representing the Fed at the Financial Stability Board and in Basel, among other functions. What role do you envision for the Fed Vice Chairman for Supervision having, and how do you envision working with this person when we get one nominated? And is it your expectation that a presidentially appointed Federal Vice Chairman for Supervision will have the responsibilities that Governor Tarullo currently has, including, and among other things, chairing the Committee on Supervision and Regulation and negotiating on behalf of the Federal Reserve in Basel?
Chairman Crapo, I think, as you know, the entire board has responsibility for approving new rules, but the vice chair would head our Supervision and Regulation Committee and would coordinate our efforts in this area. He or she would also represent the board on international negotiations of financial regulatory standards, including representing the Fed in Basel. And beyond that, the new vice chair would fulfill any statutory obligations, such as providing semi-annual testimony to Congress on supervision. I look forward to working with that individual.
Thank you very much. Secondly, President Trump recently issued an executive order directing the Treasury Secretary to work with the member agencies of FSOC to review the extent to which existing laws and regulations promote certain core principles. First of all, do you agree that it's important to promote the core principles mentioned in this executive order? And do you plan to work with the Treasury Secretary and other members of FSOC to ensure that this review occurs?
So I certainly do agree with the core principles. They enunciate very important goals for our financial system and for supervision and regulation of it. And I look forward to working with the Treasury Secretary and other members of FSOC to engage in this review.
Thank you very much. My third question before we get to the balance sheet is Fannie Mae and Freddie Mac were put into conservatorship in 2008 and continue to dominate the mortgage market. I'm not alone in calling for housing reform and considering it the most significant piece of unfinished business following the financial crisis. Do you believe that finding a durable, comprehensive legislative solution for the housing finance market is urgently needed, and are you willing to work with us to help achieve that?
Yes, I think it's very important that Congress continue to deal with the GSEs and figure out what the government's role in housing finance should look like going forward. The goal of bringing private capital back into the mortgage market, I think, is important, and I would hope that Congress would decide explicitly on what the government's role is, and if there are guarantees that they would be recognized and priced appropriately. And we look forward to continue working with you to help achieve these objectives.
Well, thank you. I just wanted to get your comments on those few issues before I go into this final question on the balance sheet. The Fed has said that it will not begin shrinking its balance sheet until normalization of the level of federal funds rates is well underway. Recently, some Reserve Bank presidents have suggested that it's time to consider beginning that process. What are the benefits of starting to let the balance sheet run off rather than relying solely